Hi, I'm Ruban Selvanayagam from Property Solvers. A question that's been gaining traction lately, and one that's starting to worry homeowners, developers, landlords, and property traders alike. Is the Labour government about to crash the housing market? The answer isn't simple. It depends on the data, the policy direction, and how confidence reacts when governments tighten rules or shift taxation. And with Labour's second budget landing on the 26th of November, this is the moment when intentions can start turning into decisions, and decisions start turning into market behaviour. In this video, I'll look at the evidence, the emerging trends, and the key considerations for anyone planning to buy or sell in the months ahead. Let's dive in. To understand whether we're anywhere near a crash, let's start with the numbers as they currently stand. According to the UK House Price Index published by the HM Land Registry for August 2025, average UK house prices were 3% higher than a year earlier, putting the typical property at around $273,000. Prices rose 0.8% in August, however May, June and July all saw noticeably quieter month-on-month movements, so the August rise appears consistent with the usual late summer seasonal pattern. In England, prices now average $296,000, up 2.9% annually. The North East continues to lead with an annual rise of 6.6%, followed by the North West at 4.5% and the East Midlands at 4.4%. At the other end of the scale, London remains the weakest performer, showing a small minus 0.3% fall year on year, with the average value of $566,000. By property type, detached homes rose 3.2%, semi-detached 4.9%, terrace 3%, whilst flats and masonettes slipped 0.8%, reinforcing the post-pandemic preference for space and family housing over smaller urban stock. Transaction volumes remain steady rather than buoyant. HMRC data shows around 94,000 completed sales in August 2025, roughly 1.7% higher than the year earlier, but still below long-term norms. Somewhat interestingly, the house price index shows new build prices up 20.5% on the year, but even the report itself warns that new build figures are currently based on very low transaction volumes. With only a small number of schemes completing in any given month, a few higher value developments can skew the average dramatically. In other words, the number reflects volatility in the data, not a genuine surge in new build pricing across the market. Meanwhile, private rents are still climbing faster than sale prices, up roughly 5 to 6% nationally according to the ONS data, with London and the North West recording the steepest increases. Adjusted for inflation, the picture looks weaker, with consumer prices rising by around 4% a year. CPI 3.8%, CPIH 4.1% in September 2025. The UK's 3% nominal house price growth actually represents a real terms decline of around 1%. In London, where prices are already flat or falling slightly, real values are down closer to 4%. Only a few regions, notably the North East and the North West, are still posting inflation-beating gains. Taken together, the pattern is clear. Rents up, transactions steady, supply tight, and real prices slipping. That's not a crash, but a slow erosion. A market under sustained pressure shaped by a limited supply, persistent demand, and growing uncertainty over what government policy will do to confidence. All eyes are now on this month's budget, the government's opportunity to set out its first full-year economic strategy. Since taking office, Labour has framed almost every decision around fiscal discipline, closing what it calls the black hole in public finances. That commitment to balancing the books limits scope for tax cuts, new subsidies, or large-scale housing investment. One possible outcome is a budget that leans on existing revenue streams, with more of the burden falling on wealth and assets rather than wages. Housing fits neatly into that logic, a sector that can be taxed and regulated without adding to public borrowing. For the market, tone matters as much as policy. When government signals consolidation instead of stimulus, activity slows, developers pause projects, buyers hesitate, and sentiment softens. The danger isn't a sudden crash, but a confidence squeeze. Fewer transactions, slower price growth, and a wait-and-see market that feeds on its own uncertainty. The construction sector has been flashing warning lights for months. The Home Builders Federation reports that planning approval in England are at record lows, barely 2.5 homes approved per 1,000 people in 2024 and 2025. Savills estimates housing starts are running 25% below pre-pandemic levels, whilst material costs remain around 18% higher than in 2019. On the ground, though, developers are facing even steeper pressures. Wages, subcontractor rates, and labour availability mean the real cost of delivering new homes is higher than the published indices imply. Developers are pragmatic. When fiscal risk rises, they slow activity, delay starts, or resequence schemes until clarity returns. And on the other side of the table, many land and development site owners are still asking 2021 prices, which renders a lot of schemes unviable once you factor in these higher construction costs and tighter lender security. Until pricing expectations realign, more projects will sit stalled, not because there's no demand, but because the numbers simply don't stack. New build completions in England have dropped to around 160 to 170,000 a year. Even after adding conversions and change of use homes, total net housing delivery still only reaches around 200,000, far short of the government's 300,000 a year ambition, and drifting further away. The same slowdown is visible in the rental market. Smaller landlords have faced mounting pressure since 2016, through Section 24 of the Finance Act 2015, 3% SDLT surcharge, wider licensing, and now, of course, the Renters' Rights Act. The National Residential Landlords Association estimates that their numbers have fallen by around a quarter since 2016, whilst institutional build-to-rent ownership has grown by about 30%. Big capital thrives under regulation. It creates a barrier to entry. What's compliance overhead for a REIT is a full-time burden for a private landlord, and that gap is reshaping the sector. Major players such as Legal & General, Lloyds Living and Granger are clearly scaling their rental operations. For example, Lloyds now manages around 7,500 homes valued at about $2 billion, whilst Legal & General has committed over $3 billion into the build-to-rent sector and delivered more than 10,000 homes. Granger itself manages over 9,000 homes and has thousands more in the pipeline. These numbers confirm that the institutional rental sector is moving into the mainstream. Labour's housing agenda, higher standards, fair rent and more oversight is well-intentioned, but it risks concentrating ownership rather than broadening it. With fewer small landlords and delayed construction, supply tightens even further, pushing rents up whilst choice narrows. Now, when housing transactions slow, it's rarely a sign of collapse, more often a pause for policy. Buyers and developers hold off until the next fiscal statement, whilst the rental market continues to run hot as demand outpaces supply. Housing moves in cycles. It retreats, then resets. To gauge where we stand, it helps to look back. In 1990 to 1992, interest rates hit 15%, unemployment doubled, and prices fell about 20%. A macro shock, not a policy failure. In 2008 to 2009, a global credit freeze cut transactions in half and drove prices down 18%. And shortly after the 2022 mini-budget, bond markets panicked, mortgage rates jumped from 2 to 6%, approvals halved, nominal prices dipped around 5% before stabilising. By contrast, 2025 looks a little bit more stable. The base rate sits at 4%, unemployment is roughly 5%, and mortgage arrears remain low by historical standards. Around 1/3 of homeowners own their properties outright, and many more have very small mortgages, which reduces the system's exposure to rate shocks. Banks are also far better capitalised than in 2008. Average Tier 1 capital ratios are roughly double pre-crisis levels, meaning banks now hold much larger, higher quality reserves to absorb losses if the economy turns. If interest rates ease further in 2026, that would add another layer of insulation, supporting affordability at the margin. Taken together, this makes a systemic crash unlikely, though never impossible. What's more plausible is regional divergence, softer prices in London, the South and the East, where affordability is stretched, and greater resilience in the Midlands and the North, as confidence adjusts rather than collapses. Property cycles feed on emotion as much as economics. Every slowdown invites the familiar wave of headlines predicting collapse because fear grabs attention. But history shows most of these calls are wrong. If you follow the UK housing market for any length of time, you know there's never a shortage of crash predictions. Type UK housing crash into Google, and you'll get thousands of articles, blogs, YouTube videos, etc., dedicated to calling the top, often for years at a time. But historically, most of those predictions haven't played out. Over the past 2 decades, we've had far more warnings of double-digit price falls than actual downturns. In most cases, the market didn't crash. It simply flattened, dipped a little, and then inflation quietly eroded the real value over time. That doesn't mean the market is invincible. Far from it. Real downturns usually happen when optimism detaches from fundamentals, what economists call exuberance, where prices simply rise because people expect them to. When that sentiment collides with a sudden external shock, a genuine black swan, that's when corrections become unavoidable. And of course, hindsight is 2020. Looking back, the triggers behind past crashes always seem obvious. The credit boom of the 2000s, the bond market panic in 2022, but at the time they weren't. What actually moves the market are the shocks no one fully sees coming. A financial crisis, a global credit squeeze, a geopolitical rupture, a pandemic, a major bank failure, for example. The broader point is that routine crash predictions rarely cause anything by themselves. It usually takes a severe, unexpected shock to turn anxiety into a genuine collapse. The bigger risk is narrative contagion. The moment enough people expect prices to fall, they wait. Buyers pause, sellers hesitate, and liquidity dries up, creating the very slowdown everyone feared. That's why understanding the fundamentals matters far more than reading the headlines. Right now, those fundamentals are mixed, not catastrophic. Transaction volumes are roughly 20% below long-term trends. Construction output is down around 10% year on year. Rents are still rising around 5 to 6%, and nominal price growth nationally is still sitting at roughly 3%. This isn't a credit-fueled bubble or a demand collapse. It's a policy-tightened market where caution has replaced the exuberance. Looking at the next year or two, there are really 2 broad paths that could unfold. In the first, we get a managed adjustment. The budget may tighten the system, but confidence broadly holds. Developers adapt to the new requirements, institutional capital keeps flowing into the rental sector, and rents continue to rise until supply begins to recover. In that scenario, prices flatten or perhaps drift a little lower in real terms, but the market remains functional. The second possibility is a sharper policy shock. If taxation or regulation overreaches, for example, if capital gains rates were aligned with income tax without any transitional relief, smaller landlords could accelerate disposals into early 2026. That could create short-term regional corrections of 5 to 8%, though a nationwide crash remains unlikely as long as credit stays accessible and the banking system remains stable. Either way, policy rather than interest rates is likely to be the main driver of housing conditions through 2025 and 2026. For buyers, this is a period to stay alert rather than anxious. Mortgage markets can reprice quickly after a budget. A small movement in gilt yields can shift fixed rate deals by 0.5% almost overnight. So it's worth watching lenders closely in late November. Local stock levels also matter more than national averages. Rising listings create negotiating powers and falling listings suggest scarcity. And with energy rules gradually tightening, homes already close to EPCC tend to hold value better, whilst older, less efficient stock may attract 5 to 10% discounts once lenders factor in expensive upgrade costs. Above all, it's a time to think long term. With inflation drifting down and capital growth likely to be modest, stability and rental yield matter more than short-term swings. For sellers, liquidity and preparation matter. Zoopla's latest analysis show the typical UK home now sells for around 95 to 96% of the asking price, roughly a 4.5% discount on average. It's a clear reminder that overpricing simply drags out time on the market and narrows your buyer pool. If you want to see how this plays out in your local area, we've included a link in the show notes of the Property Solver's asking price versus sold price tracker, which shows the gap between open market listing prices and final sales prices across the country. Showing compliance helps too. Updated EPCs, gas safety certificates, and electrical checks all reassure both buyers and lenders. Flexibility also pays off. Well-run auctions can deliver faster, more certain results, especially for properties that are tenanted, inherited, or need work, because buyers commit to a fixed timetable and contracts are exchanged quickly. At Property Solvers, we also regularly see sales complete up to 50% faster when paperwork is ready early and the route to sale matches the seller's circumstances. And even if the budget headlines briefly call demand, serious buyers typically return once uncertainty clears. Well-priced, well-presented homes still move quickly, even when the sentiment is cautious. Behind all of this lies a wider philosophical shift. Housing is no longer just social policy, it's effectively become a fiscal instrument. By raising standards and broadening oversight, the government transfers part of the cost of maintaining and regulating housing away from the Treasury and onto private owners. Politically, it signals fairness to tenants and fiscal discipline. Economically, it reduces flexibility and increases the compliance burden on investors. Property now behaves less like a speculative asset play and more like regulated infrastructure, where structure, efficiency, and cash flow discipline matter more than leverage. So when people ask whether Labour is about to crash the housing market, the honest answer is today's fundamentals don't resemble the classic conditions for a collapse. Yes, the system is under pressure, but it isn't overstretched. Banks are far better capitalised than they were in 2008, and the labour market, while softening, remains broadly stable. More importantly, the UK structural constraints haven't changed. We still fail to build enough homes to meet demand, and that chronic undersupply continues to act as a floor beneath the prices, even when sentiment cools. The Office of Budget Responsibility's latest projections underline the broader backdrop. Weak productivity, subdued growth, and limited fiscal headroom all point towards a slower, flatter market rather than a dramatic reset. And this is where Labour's role becomes clearer. Their reforms don't produce the kind of credit-driven crash we've seen in past cycles. Instead, they influence confidence, timing, and delivery. In a market this tight, even small policy shifts can shift behaviour long before they show up in the headline data. The real risk isn't a cliff edge, it's a slow, uneven adjustment shaped by tax decisions, regulatory pressure, and how quickly clarity returns after the budget. Some regions may soften, others may hold firm. For homeowners, this means fewer windfalls, but also less chance for free fall. For renters, higher standards may eventually filter through, though rents are likely to rise further before they stabilise. And for investors, adaptability becomes essential, structuring properly, managing cash flow, and working with regulation rather than fighting against it. At Property Solvers, we operate across both fast cash sale and regulated auction routes, as well as estate agency services. This gives us a close-up view of how policy shifts influence behaviour on the ground. If you're weighing up whether to sell now or hold through the next round of reforms, we can help you compare options realistically and plan strategically. A massive thanks for watching. If you found this breakdown useful, please like the video, subscribe to the channel, and hit the notification bell for more insights on auctions, fast sale, and the UK housing market. Thanks.